With all the volatility in the market right now, with all of these options prices just juiced just through the roof, a good way to take advantage of all this, instead of just purchasing long calls and long puts, is to actually sell these options. Now, when you're purchasing just long calls and long puts, they all come with the shelf life, right? And with high volatility, your option prices are going to be high. So you're going to be paying a little bit more for those options, but you're also going to get those bigger swings. But albeit if it goes against you or it stays the same, you are still going to lose money. So, how can you fix this? Well, it's actually you're going to be selling those options, because if the stock goes in your direction, you're going to make money. And if the stock stays the same, you're still going to make money. And that volatility shrinks inside that options price, then you're going to take advantage of that. Whereas if you're buying a long call or a long put, you purchase that for a pretty decent premium because of IV. Stock stays the same, IV shrinks, you lose money, not only because of the shelf life, because of the theta, but because of the overall vega and the volatility. So we're going to go through just a basic bull put spread here, and we're going to show you how we set this up and what we like to look for when we're placing one of these. So in a long put spread, and same with a long call spread, usually we're pretty, you know what I mean? Our delta's like at 60 here, and we're purchasing this put, or we're purchasing a put here, and then we're going right at the money, or we're going a little bit further at the money. And you can see our green here. This is where our profit's going to be, and it's going to be when the stock goes down. So we're purchasing that higher strike, we're selling that further out of the money strike, and it's a put, and we're purchasing a debit, so therefore we want the stock to go down. Now, if we actually sell a put spread in here, we're just going to go ahead and pick one, for example, here. We're going to sell something close to at the money, or even sometimes in the money, and we're actually going to purchase something further out of the money. And as you can see here, all this green where our profit is actually the opposite. So we actually want the stock to increase in value. But what's good for us is that the stock could stay the same, not move at all, and we're still going to collect our money here. So exactly how do we place this on, and what do we look for? Well, we usually like to go pretty close to right at the money with our short strike. Our short strike is going to be where we're going to make our money at. So we want a lot of premium here. We want a lot of juice in this short strike. We kind of want a high delta. So really where we just picked that 110 strike here in NVIDIA in the May 16th expiration cycle, that is like 100% what we look for. This is key right here. So bam, this is what we want, right? So it's a little close to at the money. You can actually go to the 105s if it feels safer, or if you want to go to like a 30 delta, you can go to here to 100. But if we are really bullish on a underlying, we want to go right at the money, because this is where all our juice is. We want all this premium to get sucked back into us. And then now what we're going to do is we're just going to purchase something $10 away. We're going to make it even. It's easier to do that. And usually we do about $10, $20 wide spreads in here when we're selling and trying to collect premium. So we're going to purchase this $100 put right here. And as you can see, we now have a net credit of 330. So actually, this is a credit. This is not a debit. We are not paying 330 for this. We are actually being credited with this 330. Now, what does it cost us in the buying power effect to place this trade? Well, it's going to cost us 670. So we're not paying 670. We're putting up the money, this 670 here, to make 330. So if the stock stays the same, we're at 110.93. So we're 90 cents, 93 cents right here in the money. If it stays the same, then we are actually going to collect this full 330. This is going to go to zero. This is going to expire worthless, and therefore we're going to collect all of that. Now, if the stock does start to go in the wrong direction, it starts dipping lower and lower and lower, and we're below this $100 strike down here, well, unfortunately, we are actually going to lose this $670. So how is this calculated, actually? Well, as you can see, we're $10 wide here. We're receiving a credit of 330. You take $10 minus 330, boom, that's how you get your 670. That's how that works. So it's the width of these strikes minus your net credit received. That is going to be your max loss. And that's also going to be, for the most part, your buying power effect as well. Now, there's also something in here that we need to be aware of, and that is going to be our break-even point. So how is our break-even point fixed into all this? Well, you're going to take your 110 and you're going to minus the 330. So actually, we're going to be right around that 106.70 area for our break even here. So we can go all the way down to 106.70, and we're actually not going to lose money. The stock can expire a little bit under in between that 110 and that 106.70, and we will not lose money in here. So that is also another thing. So really the stock can stay the same, and or it can shoot up, and we're going to make money. We're going to collect all this full credit here. Now, another nice thing about playing spreads, not only because we get to suck the volatility if the stock doesn't do anything, and it's a high volatility stock, the stock doesn't do something one day, we got to put spread on, we suck the volatility out that day, boom, we just made some money. Not only that, but it's also, it gives us a higher probability of profit. So we are putting up more money up front to make less, but our probability of profit is actually higher than it would be if we were just purchasing a long call strike. So this is above 50% here if we're just purchasing a call or doing a call spread at the kind of the same strikes. We have a higher probability of profit. So you're going to notice that throughout these, when we start talking more and more about these spreads and how to use them in these high volatility environments. And that is that you always have to put up more money to make a little bit less, but your probability of profit is going to be higher. And also the biggest thing is that your theta is plus. So don't really care about the delta that much. Obviously we do because we want the stock to go higher. So we want that positive delta, but the theta is always going to be positive for us because we are selling. So time is actually on our side when we're playing all these put spreads or just spreads in general. So that is another good thing as well. So first, it lets us take advantage of these high volatility plays in case one day, boom, the volatility sucks out, right? We can still make money. The stock doesn't have to go up or down. It can stay the same. We're going to make money. Two, it gives us a higher probability of profit. And then three, it gives us a positive theta. So we're actually, time is on our side. Whereas if we're purchasing calls, purchasing puts, time is not on our side, and we want the stock to hurry up and do something, right? We want to hurry up and go in our direction. Whereas put spreads, theta is already in our side, so it can take its time or it can hurry up too. It doesn't matter. We do have positive theta in here. So all in all, that is how we place put spreads. That is more or less what we look for. Also, last thing I forgot to say, when just a general rule, what kind of everybody goes by, you can kind of tell if there's a lot of volatility or not a whole lot of volatility in a certain underlying or the options prices of that underlying. And that is when you're selling a spread, whatever your width of your spread is, this is going to be $10 right here, a third of that. So $3, $10 wide spread, $3, that should be what you're trying to collect on these put spreads. You can see we're a little bit above that right here. So that means the volatility is good. That means this is worth our while. 53% profit. We're only putting up 670, and we're making more than a third of the width of the strikes. If we were to, let's say, let me put this off real quick. I'll take this off, and then we're going to go to the April expiration cycle here. We'll kind of do the same exact thing here. We'll sell this 110, and then we'll buy the 100, and then we're going to look at the difference in here. So you can see that actually the width of our strikes here is still $10. We're still basically in the same setup in here, right? So we're purchasing at 100, we're selling the 110, but you can see how much volatility is not left in here because now we're only collecting about 240. That's still pretty decent for only being a week away. You're still close to a third of the width of the strike. Excuse me, only a third of width of the way of the strike, and it's only got 1 week, but we still want to kind of be over that third of the width of the strike. That's how you know it's a high volatility. And especially if it's close to 40 to 50%, then you know that volatility is super high in there. And it's something that we can take advantage of. So that is also another thing to watch out for, and another thing that benefits us when we are doing placing these spreads, or even if we just place these on just to check the volatility, right? So I can go in here to the April and I say, oh, look, it's a little bit lower than third of the width. That means the volatility is kind of sucking out in here. And I compare what this is going to be tomorrow. Like, let's say NVIDIA goes up to about 112. I check this the next trading session, and this spread is trading for maybe only $2, and I say, oh, okay, looks like volatility is increasing in here. So that is also something to keep in mind as well. But all in all, that is how you place put spreads. That is what we look for. That is the reason that we like them, and how we can use it to take advantage in these market times. So if you have any more questions, feel free to reach out. You can check us out on all of our social media. We also have a Discord server, so you're interested, and we're going to go through all of these. If you have any direct questions, please just ask us. We'll explain everything in as much detail as possible. We can help you out. So let's see what we can find in this coming week to see if we can start placing some of these bull put spreads in here. And it's basically just we want the stock to go up instead of purchasing a call because the calls are too expensive, $800, $900 for a call in here. Well, I can just sell a put spread and I'm only putting up $400 or $500, and I'm going to take advantage and still participate in that same move. So let's see what goes on this week and see if we can participate using a bull put spread in here. Again, like I said, check us out on all of our social media. We have a Discord service, which we will respond in immediately when you guys do have questions, especially with these advanced strategies and things like that. And you can find all of our socials in the description below in this video. All right, thanks, guys.